Welcome, members and guests. This is Jane Chen, Vice President of the Virtual Investment Club of Sacramento. I'm facilitating the meeting today in absence of Joanne Abrata, President of the VICS. We are a better investing model club open to the public. All of our meetings are virtual, allowing us to have members from around the world and the US, including Canada and China. Guests, you will be muted during the meeting as observers and will have an opportunity for questions and comments once the meeting ends. The stocks, we won't present any stock today, and we won't have educational topics today either because we have a lot of quarterly reports to cover and discuss. We ask that you conduct your own reviews and analysis of any companies of interest before making an investment decision. The views expressed here do not necessarily represent those of Better Investing. This meeting may use products or services not endorsed by Better Investing or the club. This meeting is also being recorded for future use and will be posted to our YouTube channel. Welcome again. So, the agenda for today is we are going to have treasury report first. Should we have Haney present?
Yes.
Thank you, Haney.
Yes, thank you.
I will make him a presenter.
Yeah, thank you, Jane.
Okay. Can you see my screen?
Yes.
Yes.
Okay. So after I present this report, I'm going to have to excuse myself because I'm traveling with work and I have to get some sleep because I'm in a very far time zone.
Yes.
So I've been using my iClub to track our portfolio. I've also entered the same information in a Morningstar portfolio tracker, but I'm finding that my iClub is a lot easier to use and offers a little bit more flexibility with respect to reports. So I'm going to be presenting today using the my iClub reports. This first one is kind of new. They just instituted it a little while ago, a couple of months ago, and it's a heat map view. It shows all of the stocks that the club is holding, and the color represents absolute return. So basically, the difference between what we purchased a stock for and what the current value is. And so the dark green means that it's a higher absolute return. And these absolute returns do not take into account dividends. So that's important to note. So the dark green is like the biggest gainers and the dark red are the biggest losers. And then there's a gradient in between. So you could see that, for example, 5, HEICO, IPGP, and Biogen have done quite well relative to the others. You can also see that we're holding a fair bit of cash. Our total portfolio stands at $32,000 approximately, and that includes the cash, and $26,882.92 is the stocks that we own. Now, these numbers, I should mention, are not, these percent gains are not compounded. As I said, they're just absolute return. So this is just another picture showing the same thing. We've invested so far $24,000 approximately. I won't read these to the last decimal and so on, but we've invested $24,000, and the current value of the portfolio is approximately $27,000 for a gain of approximately $3,000, which represents an absolute return of 11.2%. However, if you include cash, we're actually negative, a negative return. So and so on the bottom here in this little chart, I started tracking by month what the portfolio value is by month, and then I did a return including cash and one without cash. So the without cash is measuring the actual return on the stocks that we selected. And let me I have a link here to an Excel file. I hope this works. It should open. I just wanted to show you how this works. So in here, can you see the file? The
Yes.
Excel file. Okay.
There.
So this is for this month, and this includes all the dividends. So it's the first column is the date, and then the action, is it a buy, a cash deposit, or did we sell something? So I put these in order, and when it says cash, that just means that we've deposited every month. We deposit $1,000, and sometimes we buy something with it, and other times we don't. So it accumulates, and that's why we have roughly $5,000 in cash, because we don't always buy something. So when we deposit or buy something, that's a negative, and when we get a dividend or we sell something, it's positive. So LKQ, for example, we bought it for $1,000 and we sold it for $1,041. So doing all of this, if you go down to the bottom, I just use a function in Excel called XIR, which calculates the internal rate of return. And this is the portfolio value at in this month, and so that's a positive number because that's the current value. The rest are all negatives, and then it works out to this 4.4%. And then I do the same thing over here, but just I do one with dividends and one without dividends and calculate the difference. So that's how that works. Let me just go over here again. So moving on, this is our sector diversification. So we have of about 50% in these what they classify as sensitive sectors, and then cash is the next biggest, and followed by cyclical stocks. And on the right hand side, you can see the actual sectors that correspond to those super sectors. So for example, technology and industrials make up the sensitive super sector, and consumer cyclical and I think unknown is Algonquin Power, I believe. So no, that's 10 cent. So that just gives you the breakdown. I put this report in the Treasurer's report directory in our Google Drive. This one gives us the company size diversification. So we have micro stocks, which is Bank of the Ozarks, 3.5 roughly percent, and in the mid range, we've got about 43.6%, and that's all of the brown colors. I must have been colorblind when I did this graph, because I was trying to match the colors to the text here, and I obviously made a mistake with so these two colors should be reversed. But anyways, you get the idea. So Comcast and Disney are mega, and then we've got a number of large companies: Tencent, Biogen, Lam Research, and Facebook. So in terms of selection, that's kind of what you want, is some small and mid-sized companies to to be the bulk of the portfolio. So I think we're in good shape that way. This graph just shows two stocks that we bought last month following our meeting. At the next day at the open, I purchased $1,000 of Intergess, I think, and 1,000 of Lamb Research, and these charts just show how the price has performed since then. So we bought ENTG at 26.74 and Lamb at 144, and their Lamb is a little bit down. They're fairly flat between the two of them. Any questions so far? Okay. Yep.
I have one.
Sure.
So there's a big discrepancy between when we account for the cash as the
Yes.
return.
Yes.
So what does that mean exactly? What does that mean? I don't know.
Okay. So what that means is, so let's say that we bought, let's see, to make a simple example,
What does it
would
mean
be
in terms
if we
of our
bought,
performance,
sorry?
like the portfolio performance? I mean,
Yeah, so
are we okay?
if you buy a stock, like if we bought a stock, say, I don't know, last year, and that stock went up a certain amount, say it doubled in value, so you made 100% in 1 year.
Mhm.
So that's one scenario. Now, if you have an equal amount of cash along with that stock, then the total value is actually 50%, not 100, because you've invested. You consider that you invested the cash, but it made no return. So when you take the cash into account and you don't invest it, it lowers the overall return. So and the way that I'm calculating it, it depends on when we put the cash in. So there's different months that we either we always put $1,000 in every month, but we don't always buy that month. So sometimes the cash will accumulate, and so if we don't deploy the capital, then the value, the return goes down because that cash is not earning any interest.
I see. Okay, so we get 1,000. We get 1,000 every month, no matter what.
Yep.
Right, but we didn't. So when it says that we lost, or our return, okay, is minus 2.3 last month and minus 4.9 this month. We didn't lose any money, actually, just that we didn't make any. So the return on that investment is negative because we're counting both the stocks and the cash. But if you just want to know how we did in terms of the stocks that we bought, last month we did 15.3%. This month it's 11.4 because the market has been very volatile and a lot of stocks went down. So it's not a bad return. We were doing, until this period of volatility, we were doing close to, I think, 30% or over 30%. So we got hit quite a bit just because of the change in the market. But I just wanted to put the cash return in to show people what impact of not investing that cash has on the overall return, which is actually, it's not a bad thing because you could invest all of it and then lose it, or it could go down even more. So, but it just, strictly from a mathematical sort of treatment of it, it does skew the numbers and reduce your overall return. So.
Okay, thank you.
Does that make sense, or?
Yeah. Mm-hmm.
Okay.
Yeah.
This report is called the Portfolio Summary Report. Again, it's on my iClub, excuse me, and it's generated automatically based on analyst estimates. So I don't do anything here. It's just whatever they have in the system for each of these companies. The ones in yellow are the ones that are projecting Analysts are projecting a low total return. So you can see HEICO is only 5% going forward. It's expected that that's as much as it'll grow. Disney's 1.2. Integris is 2.1, and so on. 5 below 2.7, and public storage is 3.4. For HEICO and 5, we're sitting now in each of those two cases. The current price is higher than the sell above price. So again, this is all done automatically using the SSG or Toolkit 6. So you could see for HEICO, for example, the recommended sell above price is $75, and currently the stock is trading at roughly 85. So, and then the same for 5 below at 120 versus 114. So those are two that we might want to think about selling.
Haney?
Yes, sir.
These numbers and the relative or the projection and reward risk, and then coming up with the sell price. Are
Right.
those based on SSGs that our club has done, or just what Toolkit has in that automatic?
Yes. It's automatic.
Because that's not analyzed. That's just using algorithms. So
Yes, that's correct.
it's good for red flags, but I would not make a decision based on that.
Right, and I think, Roy, when in a couple of slides I'll show you the same thing, but from manifest investing, and the numbers are slightly different. So everybody's got their own methodology, and yeah, you're absolutely right. We kind of have to make our own decisions, but they serve as a good flag. This one is called the gain loss report, and all it does is just show in this column, in the second before last column, it shows the actual gain or loss to date on stocks that we own. And so Bank of the Ozark, for example, we've lost quite a bit. We had bought roughly $2,000, and we're down 900, 44%. 5 is our best performing to date. We made over 161%. So a mixed bag, but again, 11.2 kind of average, which is what I showed you on the first slide. This one I was just mentioning, this is from Manifest Investing. We have a dashboard, and if you click on the link up here at the top, you go to Manifest and click on Public and click that link. You'll get this report. And so you could see, let's look at where's HEICO. So they're projecting 10.8% going forward, which is different from this 0.5. So Roy, you're quite right. But the thing I like about Manifest is they also give a quality rating over here, and you can see if you look in this top right-hand corner, our average projected annual return, the par, for the entire portfolio is 13%. The overall quality of the portfolio is 86, so that's pretty good, and growth of 12.6%. So not bad. I think we have some pretty good quality companies overall. So this is again just kind of a high level overview of the stocks that we own. And I like this one. This is called the Sold Securities Report. And basically what it does is, so it keeps track of when we purchased something, what the cost was, how much we sold it for. So it calculates the gain loss. But then in these 4 columns or 3 columns here, it says how has that stock done since we've sold it. And so let's look at CVS. We when we sold CVS, we lost about 10%. We bought it for 1,019, sold it for 913, and that's a drop of about 10%. But since that time, we sold it in November of last year, roughly. It's done 12.4% since we sold it, and then the Vanguard total stock market in the same time period did 6.5, and the Vanguard 500 did 5.86. So if we look at all of the ones that we sold here, we made two good decisions. We sold High Crush, we made 60%, and it dropped almost 73% since we sold it. And LKQ, we gained 4.2, and since we selling it, it dropped 14%. Middleby was one that we should have hung on to, and also Realty Income. So that just kind of, but I think Realty, we just wanted to hold. We had bought the two REITs more for education. We decided to sell one of them. So it was more of a thing for convenience than anything else. But I think this, yes. Mm-hmm.
I think those are annualized numbers, the percentages.
Yeah, most likely, yes.
Yeah, because I don't think Middleby's up 67%.
From the
Since
time
we sold
that,
it.
oh, since we sold it? Okay. That's the other thing, is I'm not exactly sure how they do these calculations, and depending on the assumptions that you make, you could get some skewed numbers. But
well, my guess is since we sold it in August and it's November, it takes 3 months, and say it's up 20% in 3 months. It's okay. Well, if it goes up that much, the next 9 months it'll go 67%, for the year.
Right.
That's what it seems like, at least based on what the price is today.
Yeah.
Anyway,
what I'll do is I'll play around with that a little bit more offline, and I'll try to figure out how they're calculating these numbers.
That would make sense. If something changed 10% in a month, then it'd go to like 120%.
Yeah.
Tom, can you speak a little louder, please?
Well, okay, I was just saying, like, if something changed 10% in a month, then you annualized it, that might be like over 100% or 120%.
Right. Yeah, it is actually, because it says up here annual compound annual return. So yeah, they're extrapolating, so that some of these may not be accurate, but for the ones, like, for example, for CVS, which was last year, and also for High Crush, I don't think High Crush went down 73%, but it did go down. So I'll play around with that, and I can maybe calculate those myself just based on when we sold them and so on. So some observations. There's a lot of talk about volatility increasing in the market, and the markets went down quite a bit today, so we should always consider high quality value stocks versus growth, because a lot of people are now saying that quality is going to trump growth. We don't necessarily want to sell these, but we should just have a look if they've gone up. Also, as interest rates go up, REITs will go down, so that's PSA. It's projecting an annual return of 3.4%, but it's also yielding 3.75. And just for fun, I said we should just sell everything and stay in cash for a while until things stabilize. So, and that's my report. Any questions?
Oh, it's a lot of information. Thanks, Haney. Thank you.
Yeah.
So this report, you're welcome. This report is online, and you can have a look at it at your own leisure.
Haney?
Yes.
Haney, I look at the report. You show the absolute return in percentage for the whole holding period since 2016. Is that correct? 11.4. That's since 2016.
Yes. So basically, it's the no, sorry, not the whole period. It's well, yeah, it is, I guess, but it doesn't take into account time value of money.
Exactly. So I was wondering whether you could also show annualized return, including the realized gain in the future.
Sure. Okay, I can
That
do
would
that.
be a more objective.
Well, the internal rate of return is so this one is absolute, this 11.2, but this 11.4 is actually an internal rate of return. So it's taking into account when the cash went in and out and so on.
So one thing
Sorry, go ahead.
One thing that repeatedly comes up is how much we have such a large percentage of our portfolio in cash, which yields no return whatsoever. Maybe we should try to make every month we buy something, or some months we buy two things, and eventually get the cash down to a lower percentage of the portfolio.
Well, as I was saying before, it's not a bad thing to have a certain amount in cash, because especially right now when markets are very volatile, because we could invest that and then it could go down significantly. We could lose a lot of it. So having a portion in cash is actually a safe way to go. And then for the stocks that we have, just making sure that we keep an eye on them and that the quality doesn't deteriorate. But it's a different philosophy. I mean, it's just a personal thing. So everybody sort of looks at it a different way.
Yeah.
All right. Thank you, Haney.
Thank you very much. If I'm gonna log off, but if we make any buy sell decisions, if someone could just send me an email and I'll make the necessary transactions.
Okay. Thank you, Haney. Have a safe trip. Yes.
Thank you.
Get some sleep. Win the deal tomorrow. Make more money for your company.
Haney, I'll go ahead and send it to you. I'll let you know what we've decided, if anything.
Okay, thanks very much, Roy.
Yeah.
Okay, take care.
Thank you.
Bye.
Yes. So we will have no stock study this month, and in January we won't have meeting in December. So in January, Tom, Joanne, and Megumi will have a stock study in January. So now we will go over our quarterly reports for the companies we are holding now. Tom, could you go over, present BIB?
I'm making you a presenter, Tom.
Yep. Thank you.
Okay. Tom, you are muted. Jean, you may mute yourself. I think your neighbor is doing remodeling.
Oh, okay. So I mute myself.
Yes, I can hear it. Hey, Tom, you are muted. You are muted, Tom. We can see your screen, but we cannot hear you.
Hey, Jay, if you want, I can go ahead while Tom gets set up, if that helps at all.
Okay, sure. Hi, Andrew. Okay, I'm making you a presenter, Andrew.
Okay, sounds good.
Okay.
Awesome. Okay, cool. So, I'm gonna go through Disney's Q4. So just to start off, looking at their sales growth projections. Overall, just before getting started, I'm sure a lot of us have definitely heard about Disney's strong financial performance. So that's, I would say, very evident, especially in the quarterly update that I noticed for Q4. So a minor dip throughout the quarter in terms of sales growth projections, and we'll kind of get into that in a little bit. More stagnant than I would say than a drop, and I think part of that reason was because, and I think we discussed this previously, was the idea of most of the projections show for each year individually. So when I did the last SSG growth projections, I had assumed that that was going to be on a several years basis as opposed to an individual year, if that makes sense. I think Jay, you and I kind of realized that when we had done our study, our stock pitch previously, was that usually the growth projections are not for a specific 5-year growth rate. It's an individual year growth rate. So that was partially why there's a bit of a drop from 5 to 3. It wasn't necessarily a drop in growth. It was a correction in the way that I was looking at the current growth rate. EPS.
Which stock is this?
This is for Disney.
Disney?
Disney, yes.
Okay.
So sales growth projections fairly stable. EPS growth for the quarter increase, fairly healthy increase in the EPS. Year-over-year sales growth, again, this was small decrease in terms of year-over-year sales growth, but relatively stable overall. Pre-tax profit, there's a significant decrease in terms of the current quarter. And in terms of the reasoning behind the decrease in pre-tax profit, it wasn't as evident to me as EPS growth and sales. So a lot of the reason why there was a significant and a very healthy growth rate for Disney overall was due to their current recent purchase of BAM Tech. BAM Tech is a company that focuses on streaming services for the MLB and other sports companies. A lot of successful growth trajectory for ESPN. Lots of very financially stable and very financially sound investments in terms of the movies that were released as well by Disney, as well as a lot of focus on long-term growth. So in terms of the quarter over quarter, there was a little bit of an understanding as to why that there may have been a bit of a decrease because of the focus in terms of long-term growth. So the trailing 4 quarters, as you can see, was fairly stable, 7.8, whereas the recent quarter was very successful in terms of the sales growth as well, pre-tax profit, EPS. Most of the focus, though, isn't necessarily on the short term of the company. It's more looking at a long-term growth. In terms of the actual SSG itself, so in looking at different analysts, mostly the ones I looked at were the Value Line. I looked at the Seeking Alpha earnings call, as well as Morningstar, NASDAQ, and finally Zacks. And the general consensus in terms of historical sales, as well according to BetterInvesting, was around 3%, anywhere between 3 to around 2.6. So I kind of tried to take the average, and I went a little bit more conservative and took, 3%. So historical EPS was as well relatively sound in terms of the growth rate being closer to 10, 10.8, 10.6. So again, I took a more conservative route and looked at worst case being 9. In the actual SSG report that I used here, I used 10%. This is kind of just looking at worst case. So I also did a 9%. I'll leave it right now as 10, just for our own estimates right now. As you can see, as I show in a little bit, it doesn't really have much of an effect. These are kind of just, again, so these are the growth rates, 3%, 9%, mostly based off of A, Value Line, and B, other user or investor sentiment from, like I said, Zacks, Morningstar, and NASDAQ. In terms of the valuation and the return, the current PE is, at the time of the study, was lower than the average, suggesting that Disney may actually be undervalued. So when I did my projected high and projected low, I looked at the average high as well as the high EPS forecast to generate my average high stock price. For my low, I did below a 20% decrease from the current stock price, and that's where I got the 72. And then the main variable that I kind of played around with was predominantly the historical EPS growth of 9%. Like I said, I started with around 10.6. I dropped it to 10, and I dropped it to 9. All the other variables stayed the same because the one that kind of had the most volatility in terms of investor sentiment was the change in historical EPS. So when I tried it at several different scenarios while keeping the other variables relatively constant, the quote unquote worst case scenario was an upside downside ratio of around 3.4 to 1. And constantly each scenario still remained within the buy zone. So ultimately, back at looking at the report, like I said, current PE was a 14.1, whereas the average is 17.5, suggesting that it could be potentially undervalued. However, it did increase from the last time that I looked at the quarterly analysis for Disney. Relative PE around 8.1. And when I used a EPS of 10, upside downside ratio of 3.6. So you can see that when we used an EPS of around 9, it was a small decrease just to 3.4, still in the buy zone. Compound annual return, very healthy at 17.2%. Again, this is using the forecast average PE. And so all in all, in terms of Disney's current performance, the strategic acquisitions that they've been a part of, and their overall focus on long-term growth, this influenced my decision as a buy for Disney. So a very strong buy position. Again, like I said, looking at a little bit of a sensitivity analysis, I would say, when specifically focusing on EPS, noticing that at every situation it still resulted in a very healthy upside downside ratio, a very generous return, led me to be pitching a buy for Disney today. Anyone have any questions or any concerns with some of the analysis that I had done?
So does company talk about the what is driving their future growth?
Sure. So the main things that I had seen in the earnings regarding future growth, so that like I said, their current purchase of BAMTech, which is a streaming platform for a lot of the up and coming sports that have really started to grow in terms of viewing. MLB, there isn't really much of a competitive space from what I was gathering in this industry, and streaming has become to be a very common way of viewing. So being able to optimize and diversify their ability, because like again with their purchase of Fox News, or sorry, Fox Entertainment, again with the focus on sport, it seems that Disney has continued focus on diversifying user ability to focus or to be able to engage in viewing sports, whether that be through streaming, Fox Entertainment, ESPN, and whatnot. As well, a lot of the growth that they've noticed has been in their mobile apps in terms of how they've been performing. And finally, studio and parks resorts had a significant contribution to growth, as you can see, 24%. And they only plan on expanding from there. So a lot of the current acquisitions that they're doing are for long-term objectives to kind of get a head start in terms of where they see the market going forward. That was the gist of what I was understanding from the earnings call.
So what about now? I think they own ABC, the television channel, right? How's that doing?
I didn't see as much as about ABC. A lot of the things that I had noticed were regarding as well their current movies. Disney's been very active in the past year, especially with their superhero movies. As you can see, like Incredibles 2, Ant-Man and the Wasp, very, very productive. I think there's around close to 1 billion in sales per movie. Very successful. I didn't see too much about ABC. If anyone has any additional information to add on, I looked at the earnings call briefly, so I wasn't able to get too in depth in it. If anyone saw anything, feel free obviously to contribute.
Just for the club information, I looked at Henny's treasury report. Currently, we have about 7.5, a little bit under 7.5% in our portfolio.
Okay, cool. In Disney.
For Disney, yes.
Okay. What was the limit again in terms of typically how much you want to invest in a specific company?
Well, I think we're pretty well distributed, I would think.
Okay.
Correct me, Roy and Tom. We bought Disney. I think we only bought one time, right? So it seemed like Disney have growth. That's why when we bought it, usually about 3% because we invested $1,000 each month. But now we are at the 7%, almost 7.5.
Okay, wow.
I noticed Warren Buffett recommends 5 to 10 companies for for diversification. That way you can still monitor them. So in that case, maybe you could go up to 10%. I don't know.
Yeah.
Yeah, I'm just wondering here. This I think studio entertainment, the movies and the parks, those are so big, and also ESPN. I just wonder, like, this ESPN Plus and this BAMTech, they're really tiny. Even if they grew really fast, I don't see how they could make much impact compared to the other big sources of revenue.
I think in terms of the idea of investing in these, from Disney's perspective, is the idea of diversifying the services that they provide, and I think finding a synergy that those services can provide to their direct core competency of Disney being a very quote unquote magical experience.
Well, I'm not saying it's a bad idea. I'm just wondering how much impact it can really have on overall earnings. Yeah,
for sure. And I think that's a very fair point. I think it's very hard to say currently because these are new spaces that Disney is expanding into. It is kind of hard to analyze that now. I think the best way is just to see basically where the competitors have been landing in terms of quarter over quarter success. So looking at other sports and entertainment platforms, whether that be streaming. I know Yahoo is also very heavily invested in the space as well in terms of sports streaming. Again, it is kind of hard to say because this is a very new area. The main places where I see Disney growing are, like you said, studio entertainment, parks and resorts, and especially movies. That has been a huge contribution to Disney's success this current year. Again, like the different superhero movies of Incredibles 2, Ant-Man, the Wasp, and the record breaker sales of Black Panther as well. Those have really been the heart and soul of Disney's true significant financial performance this term. I think these acquisitions are kind of, like I said, more to diversify, but I agree with you for sure. They may not be the best evaluation of how can Disney succeed in the coming year. I would focus on, like I said, their core competencies of the movie sector and the parks and entertainment where they plan on expanding.
Hey, Andrew, are you there?
Yes.
Okay. I just saw your battery charges were at the 6%. I'm so worried that we will lose you.
Oh, okay, no worries. I actually have to go, unfortunately, because I am at a school event, but I wanted to be able to definitely let you guys know about Disney. Okay. If there is anything, I can try and call from my phone, which still has enough battery. If I'm not able to join for the voting, my personal perspective is a buy for Disney. That's my position. Other than that, I hope this was of benefit, and if anyone has any questions, please feel free to let me know, and I can try and address them in the few minutes I have left.
Okay, thank you.
No worries.
Thank you, Andrew.
No worries, guys. I'm gonna sign off from my computer. If there is anything that you need me to join in on for sure, Jay, just let me know via message, and I can try and call from my phone. I'm just at school right now, so it's a bit hard to find a place that's a bit quieter. But by any means, if there's anything, let me know, and I can definitely call in as soon as I can.
Okay. Have
awesome.
fun
Thanks so
at
much,
your school
guys.
party.
Thank you.
I wish it was a party. It's a mentoring event for kids actually doing a project very similar to this. They have a valuation that they need to do for Rogers and Bell, and they have to pitch a stock where they stand in terms of a buy, hold, or sell next week. And they wanted some perspective. So
let us know if they have any good ideas, any hot tips.
I will for sure. I'll definitely let you guys know. And
no, seriously,
where it can help the group. No, for sure, definitely, absolutely. This is actually one thing I wanted to get more insight on in terms of the group. If you guys have a minute, is the group invested at all, or look into investing in more Canadian corporations like Bell Canada, for example, or is it more focused on US, on NASDAQ and S&P?
We purchased a Canadian-owned company, right? Algonquin?
Algonquin. Okay. I wasn't sure. I wasn't able to see the purchase for that one. I had to sign off early, but okay. So if Canadian-based companies are of interest, then I'll for sure try and see if.
We're interested in international-based companies. It's not, but we are focusing on the companies that they what do you call it? not IPO. What's the word? Help me, guys. They have like what's the word? Not launch. What?
Called
Tom?
ADRs.
Yeah.
ADR.
ADR in US. So because that way we can monitor we can tracking they are earnings. Or I'm not sure what's the word. Can't help me because I feel
American
like
Depository Receipts.
right.
Yeah, because to qualify for that, they have to file the SEC forms like American companies. So
Right.
we're interested in Canadian companies, but prefer ones that have qualified to use ADRs here.
Mm-hmm.
I see. Okay, that's good to know.
For
And
example, we have another company is a Chinese company, right? So they also is ADR.
Oh, right. Okay.
Right.
Okay.
So,
Okay.
we
So
want
any
things
Canadian organ.
we want things
Oh, go
we
ahead.
can research too. Things that are out of the U.S. might be harder for us to research.
Okay. I will actually hopefully be meeting with some of these groups to hear some of their presentations next Monday. Some of them will be presenting next week. And so Rogers and Bell are telecommunications companies here in Canada. I don't think in terms of North America they can compete with some of the with the telecommunications in the US. But definitely I'll definitely see if they have any interesting ideas and definitely try and report back to you guys and see if it's of any interest.
okay. We also want to hear the young kids. What are their interests? What do
Don't
they think
forget-
the future will be?
Don't forget the
In terms of
marijuana stocks.
Okay,
Sorry, what was
thank
that?
you. Thank you.
I think
Yes.
Bernard just said something.
Yeah, don't forget the marijuana stocks. Maybe someday they have a good price.
For sure. For sure. It's a lot of interest here in Canada. A lot of interest in those.
They're too expensive, I think.
Yeah.
Overpriced.
I think we
Thank you,
should
Andrew. Yeah.
move
No worries,
along.
guys. Have a good one.
Thank you.
Tom's
Tom. Okay, I'm going to make it Tom as a presenter. Tom.
Okay, I'm back on here.
Yes.
Now
You were muted and Andrew took over.
Yeah. Okay. Thanks. Can you hear me? Okay.
Yes.
Is my screen big enough?
Just make a maximize it. Did you see that little? Yeah. Yeah. Okay.
Okay. Okay. My stock is Biogen. I didn't make any changes to the stock selection guide. We're projecting 6%. Value Line's projecting 6, but Argus is 12, Morningstar 5, Manifest 6.5. Just for your just for your information, their sales and pre-tax profit growth were decent. Current PEs, relative values 70.7%, so it's below the average PE. Current price is around 320. Morningstar thinks it's worth 420. Standard & Poor's 297. Manifest is projecting 506 out 5 years, which sounds nuts to me. Upside downside ratio is 4.2, and compound annual return is 10.3%. Things are not really much different. Their biggest selling drug is facing increased competition. The sales are stable. Their interferon sales are down. Their big grower is something called Spinraza. So here's this chart shows their various drugs. Their multiple sclerosis drugs are 63% of revenue. That's down 3%. The Spinraza is 13%, but it grew 73% year over year. I know it could do that for it's a new drug. It's expanding internationally. It could have a high rate of return for in the short term, probably not the long term. A limited market because it's a rare disease. Biosimilars are up 33%, but those are like complex generic drugs. But that's only 4% of revenue. Royalties are up. And contract manufacturing, they're making, that's up too, but that's a small percentage of the company. So this Spinraza, it could continue growing, but it's probably going to be facing competition too. It's too expensive for Britain. They aren't paying for it. Their sort of holy grail, this Alzheimer drug, aducanumab, if that's how you say it. They're expecting results in 2020 for those trials. They've released some positive results. Sort of interim, but you can't really tell. They released some phase 2 results for another drug here called BAN2401. They're touting it as being positive, but the analysts are looking at it. It's not clear that it's such a positive result. So we'll just have to wait and see more trials. So they have 3 drugs that all Alzheimer, the 3 Alzheimer drugs that they all work by decreasing beta amyloid in the brain. But they're releasing some positive results, but these other companies have had failures with this approach. So it's not guaranteed, and even at best, they don't think these drugs they certainly won't cure Alzheimer's, but they might slow the progression. If you start it with people who aren't too sick, you might give them a few good years, but it could still be a huge market because there's no treatment for it. It's a pretty common disease. So I'm even though it's in the buy zone, I'm recommending a hold. They have some new drugs they're working on, and I'm seeing these Alzheimer's things are a little bit of a long shot. So I wouldn't recommend buying it currently at this price. If the price happened to go down, you might kind of speculate on it. But at the current price, I'm recommending a hold, even though it's in the buy zone. Any questions?
I'm sorry, one more time. Which company is this? I'm sorry.
Biogen.
Thank you very much. Okay, there we go. Yeah.
Any question for Tom?
No.
Okay. Do we move to the next stock?
Mina is not here. He last minute he couldn't join. So he has IPGP.
Yeah. So we have Roy.
Right. Okay, Roy.
Present.
Yes.
Okay. Go ahead and send me the screen.
Okay. So Roy gave annual report, right? Yes.
Right. And I'll just show this real quickly and then go to the actual report.
Okay.
But I just wanted to show we have bought it 3 times back in January of 2017 for $77, and then again at 104 because it had gone up and looked really great. And in August, we bought it again, but the price was down, but it looked good to me. And in the report from Value Line that I posted, it looked good to them. I'm not relying on the last Value Line report because it was done in September before the fiscal year closed. And in December, they'll have a new one that should address the shifting sands with this company. And I said on Friday it closed at 72.94. Today it closed at 70.76. Went down 3.0%. So taking the average price that we've paid, it's we're at about the 20% loss range, which they say if it's down 20%, it's a bear market. So anyway, and I will turn to the other documents in a moment, but I kept in mind the whole time I did it, is it near the bottom? Is it still a good company? And should we, buy it? Or is it going to be a falling knife? Well, if I bought it Friday, it would have, cut a finger off. But I think it will be okay. This is one of those situations where I trust Warren's theory of be greedy when others are fearful. And I saw in Nightly Business Report tonight, I forget his first name, Jajarian, anyway, he's on CNBC a lot. He said that what happens is as the price goes down, these computers kick in and keep selling. And he thinks that's what's driving the market down, because it's down all over, especially for tech and a couple other industries. So I think that'll stabilize, hopefully fairly soon, and turn around. And we should probably get in, whether it's this month or later. That's the question. So let me go to the report. So the closing price today now is the new 52-week low. It was just above it when I did the report. And the current PE is, of course, below the average PE. And on that, the average PE, Tom, do you remember? Oh, Ellis Traub, he talks about a signature PE, which is kind of difficult to figure out. But I looked at the 10-year average. I used a toolkit for that. And the 10-year average is 18.5. So I'm saying that 18 is a signature PE, which is where it likely will stabilize, and it's way below that. So to me, it's a possible candidate for more purchase. The revenue is up, but only by 2.4%. Earnings are up by 18%. And I haven't quite figured out why that is. The reports are less clear than I would like. And Skyworks believes that there's so many variables affecting their GAAP numbers. While they have to report it for the SEC, all their discussion is in non-GAAP, which they say addresses their core product. That there's all sorts of other things, lawsuits and salary bonuses and various things that affect the GAAP numbers. So they like it. And in reading the transcript of their earnings call, none of the analysts seemed concerned about that. So take that for what it is. Assets are up a little bit. Liabilities are up quite a bit more, and so they wasn't as nice as I would have liked, but it's still substantial. So, like I said, the only negative things and why they try to avoid GAAP numbers is because of increased salaries, stock buybacks, dividends. Some of the other things they mentioned were lawsuits and whatnot. There are the numbers for the sales and earnings for the 5-year and 10-year quarter and the trailing 4 quarters. The one that stood out was in the historical earnings growth rate, -7 for the trailing 4 quarters. That's a little worrisome. But the other numbers seem to be fairly decent. And the price went down substantially in November. Well, actually October and November. When they gave their reports, the headlines were that the forecasts were down. Well, I didn't see that the forecasts were really down. The CEO mentioned that there's some headwinds, but they anticipate overcoming that. And so here they talk about, and this is quoted from the 10K, or I guess this is actually from the earnings call transcript. Someplace else I have that 10K quote. But they anticipate the first quarter of 2019 to be over $1 billion in sales, with a gross margin of 51%. Recently it was 53%, so that's down a hair, but 50% gross margin is outstanding. They have enough cash. They plan to buy back some more stock. So, that's, I guess, will be helpful. They did have one acquisition that they've paid for, and I quoted that because I don't know what it means, but it's an important part of their chip products. And let's see. Whoop. Sorry about that. So anyway, based on the SSG, this report and the SSG, which I'll pull up now, I think it's a buy. I used 5% sales growth, just because the last quarter was down substantially from previous quarters, but if what they say holds true, then it'll exceed that. But I like to be surprised on the good side, not be overconfident. I used the preferred procedure and got an 8.4%. There was some question about this average high price that I used in 4A at 15%, or I mean 15 PE, because the high PE is 27.7. But partly that's based on that 2018 number of 23.5. I consider that an outlier, with 17 and 20 the two previous years. So I think it's just because of things jumping around, and they were higher than that. And also being a little conservative in case I'm over-guessing how well they'll handle the headwinds. I wanted to go to 15. One person recommended 20. I could go to 18. I don't feel comfortable going higher than that. The average low PE of 12 that's what the average low is, and I'm comfortable using that. And using these numbers, it's a 3.1 to 1 upside down ratio. When I put 18 in, somehow the earnings also had increased to $173 for the high price, which put it like a 4.7 to 1. So I didn't bother to keep that and present it because the numbers didn't seem right to me. But it's definitely in the 3 to 4 to 1 ratio and a buy. Let's see, that's about it. I did post the value line for the industry and this company, and like I said, value line was very high on it, but then that was based on last quarter's numbers, and I was also high on it last quarter. So anyway, that's the annual report I have. Any questions?
Yes, I'm also curious about their future growth. What drives their future growth?
Well, one of the knocks that some, I think, influenced some of the downturn in their price is because iPhone sales are projected to be lower. I haven't read Samsung's. They produce chips for both products. Apparently, they're in every mobile phone, even the Chinese manufactured mobile phone. But that has become a lesser part of their product line. They're doing tremendous growth in IoT, the Internet of Things. And when I first heard that term, it applied to stuff around your house. You could use your cell phone to turn on your lights and your heater and stuff like that. Well, that term now encompasses all sorts of things, and not just homes and factories and warehouses, but they are moving rapidly into automobiles.
Mm-hmm.
And then the other part that they're anticipating growth in is they're producing products for 5G cell service. They're still very strong in the 4G, and they even go back and still do a few things for 2G, and I don't know who uses 2G. I don't think it's a cell phone bandwidth. I think it's some other products. But anyway, they anticipate great growth in 5G. So based on all that, I tend to, unless they're lying like Enron, they should outperform all the estimates out there.
Well, wait a minute, too. They're putting their money where their mouth is, in that there's insider buying of the stock. So that's another plus.
Okay.
In the last 6 months, it's right there on Yahoo Finance, if you want to look it up.
Yeah, I probably should pay more attention to that. I don't. I go by raw numbers, and the numbers and the guidance seem pretty straightforward to me. So, but that supports the fact that they have confidence in their company.
Okay.
Anything else?
Any question for Roy?
No, thank you, Roy.
Okay.
Thank you, Roy. Okay, so
What's next?
we will have Facebook for the next.
Oh, yeah. That's you, Jane.
Yes.
Okay, let me give to you.
Yeah.
Jane.
Great.
Okay.
Can you see my screen?
No, yeah, I just give to you. Sorry, I was looking for your name. Okay.
Okay.
Yeah.
All right. Facebook. This quarter is not doing as well as last quarter, and that's why I have adjusted the SSG for both sales and EPS growth projection. And basically, the monthly annual user, the monthly user and the daily user has increased slightly over year, and but then they have a lot of expenses spent on the safety and privacy measure to put that in place. So they have a lot of expenses, and they also have a lot of research and development costs spent this quarter. So that drive down the pre-tax profit. And so as you can see from the stock evaluation, the price has come down to 139. Actually, on Monday today, it has decreased again. So now it's about 130 something. And at this price level, is again, is undervalued based on the quality of the company. And however, I don't recommend any more purchase. In fact, last quarter when I presented, I was hoping to realize the gain when the third quarter came around, but because of the volatility this quarter for the market in general, so it had come down even further. So last quarter, I suggested to sell it at the agreed target price around $200. But since the price has dropped and the forecast for the future few quarters, again, will remain pretty, flat, even it will decline further because of all the reasons we have discussed. They have spent quite a lot of money on putting all the safety and privacy measures in place. And so their expenses just for 2018 has increased by actually have been increasing for more than 50 to 55%. And the average price per advertisement has increased, but not as much as last quarter, only by 7% compared to last quarter is 17. And so the total price has decreased and the total cost, the expenses have been increased. So that squeezed the operating margin down to 42% this quarter compared to 44% last quarter. So with all this in consideration, I think it's still a quality stock, and I was hoping to realize the gain, to make a profit on this earlier, but then I think we voted when Tom and Matthew presented the education topic on portfolio allocation, and we voted against it. We didn't sell it at the time, but I think it's a good company, and we still should hold it. And I believe the price will eventually go up again. So at the time, we should definitely capture the gain at the time. So any question? I think this quarter specifically, Mark, the founder, has stressed a lot about all the other services they are providing in addition to Facebook. They are talking about WhatsApp, they are talking about Messenger and Instagram, and a lot of users, I believe like 2 billion users on the family of services. So they are developing the other services as well. So a lot of money need to be spent, and a lot of research and development need to be need to be made. So that's why I think it's all for the future, for the long haul. And even Value Line, I think they have suggested that for the long term, investor, this is a stock that can be considered. However, not at this level of price, because it's 146 at the time. Now it's close to 130, lower at 130. So I think it's something that a long-term investor should consider. However, we should expect volatility continuously because of the prospect of the company spending more money, at least in the future quarters, a few future quarters. So I would suggest that we still hold the company and then monitor closely quarter to quarter. And then at the time that the sales price hit around 180, 190, then we can capture a portion of the profit. Any question?
Well, I kind of think this is a great buying opportunity, and I did look this one up also for insider transactions, and there's a lot which is unusual for Facebook because it's usually sales, but now there's a significant amount of insider purchases in the last 6 months, as seen on Yahoo Finance, of Facebook stock. I think this is a buy. It comes up on the SSG, a buy. And
I agree with you, Bernard, if we don't have such a big holding, because we have purchased it like 2 or 3 times.
4 times.
4 times. Okay, 4 times. We have purchased 4 installments of 4,000. So I think now we have a big position. I agree. I still love the company. I may consider buying it because I purchased it last drop around 140. Yeah, and then I sold it for that around 190 at the time. So I captured the profit then, but then now it's close to 130, and I will consider buying it myself. But in terms of the club's portfolio allocation, I would think that we should just hold it. And if I'm open for purchase more, but I just want to make sure that we don't have a big position on one single stock.
So we bought Facebook 4 times, and currently we have about a little bit over 10% of Facebook. Just I'm looking at Henny's chart.
I can show you the SSG based on what I forecast for sales 18 and for the earnings per share growth. I use the preferred procedure to come up with 16%, and based on this, you get an upside and downside ratio of 5.1. So the projected rate of return based on average PE is about 17%. So it's a decent return, and it's a good company. Definitely, it's a financial standing of A++. And again, as I said, I already captured profit last increase. So I will consider buying it again myself. But for the club, then it's up to all of us to decide.
Yeah, I was just looking at the intent of a company buyback. I was reading from Fortuna Advisors saying that buyback strategies and tactics can be misaligned with shareholder value. So I was wondering about because the stock price dropped, I'm wondering if that is company's tactic, to comfort investors. Hey, we're going to have less shares. We're going to buy back such $1 million. I'm just wondering.
As far as I understand, it's always a tactic. When there's something wrong, they always announce their buyback program. So it's always
I think the price is going down because Facebook is going to be regulated. Congress is going to trim some of their margins. That's, I think, what's causing the price. That's my opinion. I don't know, but that's what I guess.
But I do see a lot of, in the conference call, I do see a lot of discussion on the research and development and the products they are putting in place in the future. And they have spent a lot of
I like it too, Jane. I like it too.
They have spent a lot of money legitimately. And it's one of the best companies to work for. In the US, I believe. So I think I like the stock myself. At this price level, I love it even more. But then it's up to the club to decide.
I think we should hold. because we have purchased 4 times, and I'm just curious, have someone to watch this company just to see, help us to monitor, their future kind of direction. I know Matt is huge. Matt is really against Facebook from the beginning.
Yeah.
I don't agree to buy more, even though it is in buy. But I'm really curious about this company, where they headed to. What's their plan? I went to their shareholder meetings last year before.
Okay.
Yeah, I went. So I bought it 2 years ago. After I went to that annual meeting, I was kind of really like Mark Zuckerberg and his sincerity. I talk about that when this company was presented. I waited for a long time for me to buy this company. I'm really curious. I'm disappointed. Yes, it went down. I would like to have Jane continue follow to help us to monitor and understand the direction of that company, and any potential growth for the future.
Yeah.
So
Definitely.
I would suggest to hold as well. I'm prefer to hold as well myself.
Okay.
Yeah,
Any other?
and they've been getting a lot of negative press lately.
Right.
Yeah, and it's I think part of the sell-off is partially Congress, but I'm more worried about the EU. They seem to have
True.
Facebook in its sights, and I mean, call me a heretic, but I believe England will be a lot better after Brexit. I don't like the EU muscling on companies the way they have, or I think unfairly. So I mean that's part of what I see happening with Facebook, even though I'm in Matt's camp.
Okay, but as I said, we will definitely capture the profit. But I can't say that. I'm sure the stock price will still volatile, and it will go down even further. But I think it's a quality company to hold, and even if we want to sell a portion of the position, we shouldn't do it at this point of time.
We capture profit. There's no profit. We lost 20%, almost 21% at this point.
Yeah, overall, we are still making a profit, right?
Are we? Oh, I was just looking at the treasury report. Look like we're losing money, are we? We lost about 21%
for the whole position.
For Facebook. Oh, yeah.
Yeah, I think we bought it when it was high also.
Yeah. I'm just looking at the spreadsheet that gain and loss that Henny created, but I'm not sure if that is. So we bought 4 times. It says total year return negative 20.93. So we bought at the price 175, 152, 167, 179.
Oh, okay.
Yeah.
Right.
So it is a loss at this point.
So how are we doing time-wise? We still have quite a few reports to go, don't we?
7:25. Yes.
Yeah.
Okay. So.
Okay. Great.
All right. Okay. I think is the next me. Oh, Joanne. Public storage. She's taking class for her company, so that's why she missed the 3 meetings. Should
I present ENTG since I'm on the screen?
Okay. Oh yeah, sure. Go ahead.
We will be presenting. We'll be keeping track ENTG because I presented last month for purchase, and so ENTG, nothing has changed a lot because the quarterly report just issued right after our stock study, and revenue growth again is projected to be 11%, and the EPS is about 16.4, and it's a stock that is being undervalued. That's why we consider to purchase it last month. And if you look at ENTG, the SSG based on 11 and 16.4%, we have this. I think we went over this, so I'm not going to go into detail. We have this 5.5 upside and downside ratio, and the average return for the projected return on the average PE is close to 20%. And again, it's staying pretty well. I mean, during this downtime, this volatility, during this month or so, the price has been holding up. Even though yesterday it dropped for a lot of stock, it all declined. But then the price is still holding up pretty well. I think we purchased at that 26 something or 27. So it only dropped slightly from our purchase price. And for all the financial indications, then it is still doing well and is still expected to do well. And again, because of market condition, the volatility is expected. And I think this is a company that we should hold and continue to monitor.
Yeah, I'm wondering the ripple effect. You know how Skyworks, for example, talking about this company, they is making the material for semiconductor for chips, right?
Yeah.
So Lam's research is the manufacturing for the chips. So the Skyworks price went down, and now is in the bear market. I'm wondering, is the ripple effect like they are right now all undervalued? Because it's kind of like a chain, right? Material, manufacturing, provider, supplier.
Yeah.
Yeah,
And
they're all out of fashion, but the cycle will come back. They will go up again, I think.
I mean, in this area, in the semiconductor industry.
Semiconductor. Yeah, I agree with you, Jay. And uniquely, ENTG is a chemical company supporting all the semiconductor manufacturer. So they have all this purity solution to help them to increase their productivity. So in that sense, they are not bound to the risk that semiconductor equipment manufacturer or semiconductor manufacturing companies are facing. So I think in that sense, ENTG is okay.
I see. So I just saw your SSG. I forgot. Can you recap again? 2014, what happened? There was a big dip on the profit.
That's
the other one. ENTG.
That's a tax adjustment.
2014. Can you go to the first page? 2014. What happened there? I forgot.
2014. I think I make adjustments. Do
you remember what happened there?
Let's see.
This maybe needs to cross out 2014. I was wondering what happened. I don't remember.
I remember now. Yeah.
Okay.
It's an acquisition. It's a very major acquisition that they did. Yeah. So they spent a lot of money on that, and that company was integrated well. That bring them to today.
Okay.
So that was yeah.
Okay.
Yeah. If I show you this presentation I did last month, and they have 4 acquisition. And the reason why is the ball gas purification company. But at the time of 2014, they purchased ATMI. So they did a big purchase.
I see.
Compared to the other. So they spend a lot of money, and they are very strategic in acquiring companies, and their cash flow position is good. So they are always look out to buying more companies.
I see. Okay. All right.
Great. So I think we should continue to monitor both Facebook and ENTG, and ENTG will be followed by Joanne because I was a presenter, but I did this quarterly report because Joanne did the other report for Haney.
Okay.
Okay.
All right.
Okay. So should we have the next company?
Okay. I think it's me.
Are you? Yeah, going to.
Okay. So Ozark. one month, Ozark Financial Services, a regional bank company, exactly a month ago today, Ozark dropped almost dropped to 26%. So we lost about half of that value, and I'm not going to. So I want to address what went wrong, what happened. So basically, is the real estate loans had deteriorating the assets. So there were two properties. One is in South Carolina, and one is in North Carolina. I think it was due to JCPenney and Sears. They lost. I can't remember. So shopping mall. They lost something about enclose a shopping mall, so impact their portfolio. So these two major properties had huge impact their real estate loan portfolio. That was the major cause that impact that the stock price went down almost 26%. However, the analysts ask many questions about, how company is going to handle how they manage for the future. So company seems like very confident, and they believe that this is just one time thing, and it's not going to happen sometime soon, and they are not going to change their business model. They think their model is working, and so they believe they are still their business model is still very conservative, and they are going to do they still going to do originated loans. So I did some research, just want to see what other analysts say about this company. I read about Seeking Alpha. Unfortunately, Seeking Alpha, if you need to read more, they ask you to pay. You have to subscribe. And I only captured the summary of what Seeking Alpha analysts stated. Also, I think Zach have something to say, but really, I think Zach recommended us to sell, I think, and also explain what went wrong. I felt that I want to give another chance for this company, and I still kind of really like the management. I did SSG and on this company. I did not do research to find out what other analysts say other than, this. I took a 3% only from this 2-year estimate, 3%, because I'm not suggesting to buy more or sell. I'm just curious. Okay, I think 3% is very low compared to my last SSG, or compared to their growth. So with that 3% forecast sales and earnings, it still came to as a buy. But I'm not just recommending. I don't recommend to buy more. I recommend to hold, to watch. Give this company a little bit more time to see what is going to happen, and hopefully that it will back up. I do believe one time was at the Doug Golosh's presentation in Sacramento. Doug was saying how bank makes money is when interest rate goes up, impact to the bank, not like real estate, not like REITs, your interest rate goes up, but REITs going down. I think what he said is that interest goes up and a bank will make more money because the loan the loans goes up because the more expensive is that how I did some research to try to understand how myself to understand the correlation between the interest rate and the bank loan.
Well, Well, they might have more of a spread, like what what they pay for deposits is one thing, and what they charge for loans is another. And when interest rates go up, they have more margin.
More
That's right.
margin. Okay.
Yeah.
Yeah.
And another thing too, a lot of 76% of their loans have variable rates. So if interest rates go up, the loan payments increase because
That's
of the
right.
variable rate loans.
Mm, okay. So yeah, my final recommendation is to give this company another chance to wait for another quarter, maybe 2 quarters, because the next quarter is the annual report. Maybe, yeah, just wait a little bit longer. Be patient.
What's the quality of the financial condition? According to value line, do they have value line report?
Yes, the value line is outdated. It's just like the Skyworks. I don't recommend, even though I provided the value line. It's outdated. Let's see, Ozark. Where's Ozark? Oh, here.
And by the way, I remember Jay, you presented Ozark, right? But why are you following Ozark?
Why am I following Ozark, Bernard? Well, okay.
She is the only one with guts enough to try it because Bernard and I struggled and
I see.
that on our face.
Yeah. So Bernard was following Ozark, yes, and
I think I did it for a year, and then somebody else, Jay, took it over.
I took over because you struggled and have some challenges, and I think we asked Henny to follow, but Henny doesn't want to. Henny said he doesn't know bank, he does not feel comfortable to follow, and because I studied bank based on the Ross presentation to understand a bank. So I took over. Yeah, you're right. I violated the rule of our club that presenters don't follow their own company.
Attachment to it.
Right.
So it would be hard to use it.
Right. I'm happy to have anyone else to follow. I don't have to follow.
Well, yeah, you sound neutral. That's okay with me.
Yeah. Can we move on to the next stock?
Yeah.
Yes.
Yeah.
Who's that? Who's that? Bernard? Comcast. Bernard, I make you a presenter.
Okay, let me see if I can do.
You can do it.
Please close confidential window. What the hell's that? Then ready to show my screen. Okay. Show your screen. Wait a minute. Let's see if I can do that. Okay, here it is. Can you see this?
Yes.
Okay. So this is Comcast. And let me go down to the oh boy, can I navigate this thing? I'm not. Come on, it's not going. Oh, here it. Oh no, damn! I lost it.
So
wait a minute.
Okay. Do you feel comfortable have me to navigate for you?
That would be okay. Yeah, I have trouble. I can't drive the damn thing.
Yes, you can. So would you like me to present for you? You just walk through. Okay, I can show the screen.
Yeah, just show.
Okay. All right. I will look the Bernards very quick. Okay. Oops. Sorry. Thank you. Comcast quarterly to this one. Okay.
Okay. So the company is doing okay. I mean, we had expected a sales growth of 5%. That's what we're getting. Sales growth of 5%. Earnings growth is even more, 12%. Trailing 4 quarters, 153%. And so this company's performing right. And here's the thing too, it's got a very low PE now, where the average PE is 13.15. The PE now is 7.53. And the upside down ratio is 5.91. The compound annual return, 22%, using average PE. So Brian Roberts, the CEO, he says that earnings growth, or EBITDA growth, was the fastest in 6 years, NBC has finished the 52-week season ranked #1 in total viewers. Recent acquisition of Sky is transformative for our company, helping create a global leader in media, technology, and broadband. Now, here's something I read about it somewhere, and I didn't get it in my report. Comcast started out in one little town as a cable TV provider, but it over time has grown and grown and grown and grown, doing quite well. The quarterly dividend.
Sorry. Mm-hmm.
Yeah,
Oh, sorry. Yeah. Go ahead. I'm
the
sorry.
quarterly dividend increased from 1.1575 to 0.19, a 20% increase. About 1% of the stock has been bought back. The total current assets are 23, I guess that's million, and the total current asset liabilities 19. The current ratio is 1.2. That's low. They have a lot of debt, but they're doing pretty well. And actually, when I did a stock selection guide, I did my own. Although the one that was done last month, I think by Jane is good. But it comes out to a hold, but actually with a limit order, you could buy it. It's the price. You can't see it on the screen here, but if you go to the stock selection guide, you'll see that it's almost in the buy. It's just right on the line with the hold price. Hello, am I still here?
Yes.
Yeah, I can hear you. Good.
Oh, okay, good.
Jay, can you switch to the stock selection guide?
Oh, I don't have. Is this the one?
I put it up there in a PDF file.
No, I don't have your. This
That's
is old.
right
This is
there.
August. Oh, this one. Sorry. Yeah, that one.
Yeah.
Okay.
Okay, so you'll notice how the profits are going up pretty good, and the pre-tax profit also going up pretty well. And here's another one too. Not only buying back stock, but there's actually been in the last 6 months been some insider purchases, much more insider. Well, not a much more, but more insider purchases than sales in the last 6 months, according to Yahoo Finance. So it seems to be doing quite well. So you could almost buy it, but I recommend a hold. But it's if you get down to you can see the graph. Oh, you can't. It doesn't show up here on the, but it's right next to the price. Current price is right on the line between buy and hold. But it's not quite in the buy zone. But it's very close. Might even be in the buy zone today. Everything went down, but I don't know.
I'm curious.
Could we see page 2?
Mm-hmm.
I got to learn to drive next time. Okay. And this one here for 5-year performance is pretty good. I mean, it's given a good return. The main worry, I think, is the debt. They own the capital. Is I think of like 79% debt.
Why are they that so high?
Well, because they bought Skyworks and periodic.
What? They bought Skyworks?
Yes.
Well, I think it's that British company Sky TV or something like that.
Oh.
Not Skyworks. They're not Sky TV, right? So they have cable, internet, and television in Europe now, especially England. But so they're becoming an international company instead of just a U.S. company. Because they bought not Sky, like Tom says, it's not Skyworks, but it's Sky Sky Television. It's
Hmm.
a European cable company.
I'm curious, why did you cross out the first 5 years here?
I figured it's sort of like somewhat irrelevant that we just trying to figure out the future. So the first 5 years, the last 5 years are the most relevant. I could have left the others in, but yeah. And there's something else I did. No, well, no, I can't. But anyhow, just because I thought the last 5 years were the most relevant. That's why, Jay. I could have left them all in. They're all pretty similar. And we've also out there, we have the stock selection guide that was done, say, a month or two ago, but and it was very similar, except it said buy. At that time, the price was 32. Now it's 37. The stock price has gone up. And so it's definitely a good hold, I would say. And possibly.
Any question for Bernard?
No.
Okay.
Okay.
All right.
Who's
Thanks.
next?
That's my
Bernard.
report.
Oh,
Thank
Tom
you.
again.
Yes.
Okay. Can you?
Yeah.
Oops. Okay. Can you guys? Oh, wait a minute. I'm on the wrong thing here. Okay.
Right. Yes. There you go.
Wait a minute. Oh shoot, my mouse died here. I got to put new batteries in it. So I have them right here. Well, I changed I left the sales projection the same at 8%. You can see the analysts are kind of all over the place as to what they're recommending. But I do propose that I changed a little bit of the values on the preferred procedure. I changed the shares outstanding to wait a minute, this doesn't want to work either. Unless I
Do you want me to present?
Um,
You can talk through.
well, I can just switch over to here, this other pad.
Okay.
So
Yeah.
I changed the shares outstanding down to 155 million by the value line estimate. Hanny had it as 175. It was 165 at the last quarter report. So that would increase the growth rate, or the EPS growth rate would be the same. And also I dropped the tax rate down to 15%, which seemed kind of unreasonable to me, but that was the company guidance. I mean, I think like the Tax Act or whatever puts its corporate tax at 21%, but the company was guiding for 15%. I don't really know why, but anyway, that boosted the EPS projection. And so they've done well over the past 4 quarters, but the most recent quarter, their sales growth is down, their pre-tax profit is down, because they've been selling less equipment because their customers aren't buying it, because the prices of chips are down. The flash memory chips and the RAM chips, that's primarily their customers are primarily in that market. So their customers, at least in the short term, they're not expanding because the prices of these chips are down, and they're not really expected. Maybe in the next year or so they might come back, but the demand is down for their equipment, and So, this, I guess, RAM chips are expected to fall 15 to 20% next year, and the flash chips are price is expected to fall 25 to 30% next year. Management is expecting better results starting next quarter, in the March and June quarters. And they say their market share is growing. Let's see what else here. So they bought back about 10% of their stock last year, and they paid $190 to $195 per share. Share price today is about 144, so it looks like they overpaid on that one. But I guess they'll be buying back more in the future. Analysts have lowered estimates in the last month. Morningstar foresees strength in the logic and foundry market, which is a smaller market share of their equipment than what goes into the flash chips. But from their customers of Intel and Taiwan Semiconductor, most of they only have 5 or 6 major customers. So that's their customers are not real diversified. But as time goes on, customers will require more sophisticated equipment, and so that I guess there should be long term. It was probably okay, but in the short term, it's kind of iffy. So the current price was. When I wrote this, it's down about $3, but Morningstar fair value is 185, S&P fair value is 232, Argus 1-year target price of 200. So those analysts are somewhat positive, and I'm thinking, I'm recommending a cautious buy. I think this is a cyclical industry, and things will probably improve in the long term. But we shouldn't expect, and the whole, technology is down. All that segment of the market seems to be down too. So we shouldn't really expect any returns, much returns in the near term. But possibly over the next year or two, we might see something. And the relative value is 71.4% if you compare the current PE to the average PE. So I don't know if anybody has any questions.
I'm good.
Looks good, Tom. Thanks.
Okay, thank you.
So
Do we have more reports?
Yeah, I think we have one only, but then Joanne is not here to present, and
Okay.
also Hayden is not here. So
Matt has one. We missed it. FleetCor. Matt.
Is Matt on the
It's a
line?
hold, so I don't think I
Yes.
presented, right?
Nikki, not see anything. I just caught it. Yeah, we missed you, Matt. Okay, I make you a presenter.
Sorry.
That's okay.
Oh, I don't have anything to present. I'm on. Hold on 1 second.
I can't.
It's just a hold. I don't have anything to add really. It was a very normal quarter.
What company?
FleetCor.
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 Let me see. Okay, I can't open up his report. Okay.
I thought we weren't supposed to present if it was a hold, though. Isn't that what we decided?
No. If it's a hold, you don't need to present SSG, right?
I thought it was just period. We didn't present.
No.
Oh.
We just send the report ahead of time and then answer questions.
Oh.
I think when we have other topics like self-study and education topic, then we don't have time to go over quarterly reports in detail. But in our situation this month, we don't have those, so we can present.
Yeah.
Well, yeah, but we should, like report that you would give 3 minutes max.
Yeah, we should go faster than we did. Yeah.
Okay. So let me look at it right here. Sorry, I closed my screen and everything. I was just listening.
That's okay. You can look at my screen.
Well, I don't even have that open, so I'm just listening to you guys talk at this point. Yeah, it was a very average quarter. They were actually negative earnings. I don't remember the percentage off the top of my head, but it was mainly due to a large sale of a part of their business in the year ago quarter. But even with that, I believe it was still negative single-digit earnings growth. But there was no negative reaction when they reported earnings, so it must have been what the market was expecting. So I did make a change to the SSG. So the analyst estimate was for, I believe it was 18% growth, but when I did the preferred procedure, it gave me, I believe it was 7%. So I just averaged those two for the SSG. And when I used that, it was, I think, about a 12.5% earnings per share growth. So I plugged that in, and then I kept the high PE and the low PE the same from last quarter, which was around 22 and for a high PE, and I think maybe 15 or so for a low PE. So doing all that, it gave an upside downside ratio of 3.0 to 1. It's right on the border between a hold and a buy. But for me, it's a hold, mainly due to the preferred procedure calculations, which showed lower earnings per share growth, and then also going with the negative earnings that they have seen this year, and that they're only forecasting for 7% earnings growth for this year. So given all of that, I recommend a hold. Any questions?
Okay. Any question for Matt?
No.
Okay. Then we conclude our quarter report for this month. And next month, we will have Maguni to cover FI, and then Haney, Tinsan, and Roy, HEI, and Jude, the annual report for Disney. So the floor is open for discussion and voting of any possible buys and sell.
I think based on the reports,
Yeah.
Andrew recommended to buy Disney. Roy recommended to buy Skyworks.
And Tom cautiously recommended to buy.
I recommended a buy on Lam.
On Lam Research. Okay. Mm-hmm.
Cautious. Any motion?
Well, this may go against what I said several months ago, but since we have $5,000, we have the money. I think the buy recommendations are solid. So I guess my motion is we buy those three companies.
Oh, I second.
Yeah.
Okay. So go to the ballot form in the email sent by Joanne.
I think then it's open for discussion, right?
Yeah.
Yeah. Open
Okay.
discussion.
Open for discussion.
Yep.
No comments. I think we have money, and these three companies sounds good to me. And especially right now, as the price all got dropped, I think they are all undervalued. It could be a good time to buy.
What were the three again? I'm sorry, it's Skyworks, Disney, and what was the other one?
Lam Research.
Lam Research. Okay.
Yeah.
For me, Skyworks is too high of a percentage of our portfolio to buy more.
Oh, is that okay? Let me take a look. I don't remember what was.
I think we're at 9 point something percent.
We bought multiple
portfolio
times.
On Skyworks. Yeah.
Oh, okay. Let me have a look. What was the Trails report? This one that. We bought Skyworks 3 times. Wait, we are losing money on it? We lost 22%?
Yeah, did you look at what I presented?
Yes, I did.
Yes,
right. Yes, you did. Sorry. Yeah.
I understand, Matt's point. It just seemed like I
want to see what's
it's
the percentage.
It's gone down so much that it's, and that's not the reason to buy, but the fact that I think the guidance is good, it'll rebound. So having another few shares of it would make our portfolio do great. But like Tom was pointing out, this industry has been taking it on the chin for a few months, especially the last month. So
yeah, I agree with everything Roy says. I don't know. I try to stay under 10% personally for any one company.
If there are strong feelings about it, I can modify my motion.
Well, that's why we vote, right?
So what percentage would it be if we added it? If we add Skyworks, would it be like 11 or something like that? Or?
Yeah, 11 or 12.
Yeah.
Which isn't, so far out of.
How did you calculate the 11, 12? Do you just add it?
In my head.
Gee, I was thinking about 10. Would that be 10%?
Well, if it's 9 now.
9. Oh, sorry, I looked wrong. I looked at Disney. 7.67 right now.
Oh, is it?
Yeah. Sorry, I'll make it bigger.
Oh, okay. So it may still be under 10.
Yeah.
Yeah, and we'll get nothing out of cash.
We have money. We have cash.
But there's no return on cash. That's what I'm saying.
Yeah, but zero is higher than
doesn't
negative,
go down.
Bernard.
Right.
Well, this could be a buying opportunity, possibly. We'll never know.
Matt saying 0 is higher than negative.
Yeah, I agree.
I will agree with Matt. Similar reason for Facebook. We don't want to get any position higher than what we think originally.
So Facebook has 10%.
Yeah. So Sky close to 10%, right?
Skyworks is 7%. So if we purchase it, it will be 10%. Right now it's 7%.
Yeah, well, it'll probably be like 9% then.
Right. So I think,
there's room.
Right. I felt it's a medium-sized company, and we have other 2 semiconductor companies. Let's add another one, a little bit more. Just, I don't know.
Okay, I'm going to stick with my motion. You can vote it yay or nay.
So should we motion to vote one at a time, or should we motion?
I think one at a time.
We could.
Otherwise, kind of like a mass. Oh, I would like to buy other 2, but not Skyworks. Then
exactly.
So
Right.
Okay.
Right. So which one first? Disney first?
Yeah.
Go ahead.
Go ahead. First.
Right.
Okay.
This does purchasing both of these technology stocks really puts us in that technology sector heavily.
Yes, it is. Yes. Technology is already 37.
Correct.
So that's my only reservation.
That's right.
But I felt this economy, this environment, it is technology driven. I felt anything, more or less, even bank, right? You do online banking, banking. Some point you do with technology. Automobile, some point. So
technology is moving forward, but that's kind of, if you look at the S&P or the overall market, it certainly doesn't have. I don't think technology has that big of a weighting.
Yeah, definitely not.
Tell you what, I will amend my motion to buy Skyworks, and then you can vote on that individually, and then if someone wants to buy the others.
Okay, so anybody second the motion to purchase Disney?
I would second the motion about Skyworks. Well, what's the motion was trying to second?
Disney, because Andrew presented the first.
I would second that motion too.
Oh, you will?
Megumi said something. Megumi, what did you say?
I said, is the motion for Disney or Skyworks?
Okay.
Let's do them one at a time, and to
Right,
avoid
one at a time.
confusion. So first
Okay.
one, I guess we said Disney.
Disney,
Okay.
right. Do we
Right.
vote? Go to the ballot form in the
Yes.
email.
Yes.
Join.
Okay.
Okay, you can vote now.
Okay,
Okay.
so this is for Disney.
Yeah.
Right.
Okay.
Yes.
For Disney. And Jay will count the vote, and then we
Right.
can go next.
Yes. Yes. That's Disney.
Well,
Has everybody voted?
Waiting for Bernard.
yeah. I vote yes. I can't seem to get my ballot.
Okay, it does not really matter. And motion passed. So 67 versus 33.
Okay. So
So motion passed by Disney. So Roy is taking notes. Send it to Penny.
Yeah.
what's the next one? Skyworks or Lamp?
Skyworks.
Okay.
Okay.
So I made the motion and Bernard seconded.
We need to reset the ballot.
You don't need to. You just go ahead.
Somebody
yes or no.
needs to.
I don't think
I
so.
already did. I already did. Okay.
Okay, let me
Yes.
see.
Okay.
I vote yes again.
No, you don't like cash in the account, right?
Oh gosh, it's tie. Let's see.
Just a second. I haven't voted yet.
Okay, I know. I'm just saying it's like we need somebody to untie the motion. Right now it's a 50-50. So we need Bernard to break the tie.
Well, I vote yes.
Oh,
It works. Yes.
okay. So then, yeah. See, 50-50. So the motion is by what? 1,000? So maybe, but it's by 1,000 for each.
Yeah.
Okay.
1,000 each. All right. So
Okay.
should we
One
vote
more.
next?
One more, right?
Okay, the ballot needs to be reset.
Yes.
Yep.
I do
Well,
that right now. Okay. Done. Okay. Go ahead.
Just 1,000 value in land research. Let's vote.
I second the motion. I vote yes.
What sector was that? Sorry.
Land research.
Well, it's technology. It's semiconductor manufacturing equipment.
Okay. Thank you.
So Bernard, what are you voting for?
Well, land research.
Yes.
Yes.
Yes. So motion failed. Actually, doesn't matter what Bernard's vote is. Motion failed. Sorry, guys.
Okay. So the decision is to purchase 1,000 value in Disney and 1,000 value in Skyward
Mm-hmm.
this month, tomorrow.
Tomorrow morning, yeah.
Mm-hmm.
Tomorrow. All right. Great.
Okay.
And so any other matters for discussion? And I'm sorry about the noise in the background. Somebody is innovation. Sorry about it.
Just to greet our guests.
Yes.
Yeah. Thank you.
Okay, I'm stop recording.